Okay, welcome once again, guys. So in this video I'm just going to give you a run through of I-16, which is property, plant and equipment. So with property, plant and equipment, PPE I-16, you want to account for what? You want to account for the value or the closing balance, right, of what? Of assets that you use for long-term purposes, or of the assets that you use in the generation of profit, right? So there is property, plant and equipment. You are looking at things like vehicles, equipment, and other tangible assets like land and buildings, right, etc. Right. So if we say that these are long-term assets, right, these are long-term tangible assets, right, or these are fixed assets, it means that you are using them over the years, right? So that means that as you use the assets, they are going to be they are going to depreciate, right? So they are going to depreciate. To depreciate, ukuguga kwempahla ngesiZulu, yeah, kaSuthu, since we are in Bloemfontein, kuthi ufala, yabo, ukuguga kwempahla, yabo. So it's the wear and tear, right, of assets, right? So that is depreciation. As you use the asset, they wear out, the tear as well. So that in accounting terms is called depreciation, and depreciation is an expense. So in the year in which the asset depreciated, you are going to calculate the depreciation expense, right? So every year the asset is going to wear and tear, or lizoguga, and then iguga lempahla, when this asset depreciates or when it loses value, you are going to calculate the depreciation expense for that particular year. So every year you are going to calculate the depreciation, right? The depreciation that you calculate is going to add up, right? So if you use asset year number 1, right, and then the depreciation is 2 rand. Year number 2, the depreciation is 2 rand. That means that at this point, right, the accumulated depreciation is 2 rand. At this point, the depreciation that is accumulated is 4 rand. Then you use the asset year number 3, the depreciation is 2 rand again. And then that means that at this point, the depreciation that has added up, the depreciation that is accumulated, is 6 rand. So that is the difference between depreciation and accumulated depreciation. Depreciation, we debit, when we record this, we debit depreciation every year. So you debit depreciation, statement of profit or loss, then you credit accumulated depreciation, right, statement of financial position, with the amount, right, with the amount. So this is how you record every year when you account for the depreciation expense, right? It's very important that you understand this channel. First of all, accumulated depreciation is depreciation that has added up from previous accounting periods, because you've been using the asset every year. It's going to depreciate. That asset is going to accumulate over time. So when you are dealing with depreciation, then it's very important that you are able to interpret and understand the information that is given to you, right? So when you are dealing with depreciation, the first thing that you need to consider, number 1, the first thing that you need to consider is the depreciation method, right? So with the depreciation method, if they say we use the straight line method or the cost method, right, it means that when you calculate depreciation, these are the things that you are going to use. You'll start with the cost, and then follow with the residual value, and then to get the depreciable amount. So you'll say cost minus the residual value, and then you'll get the depreciable amount. And then from there, you'll calculate depreciation using the depreciable amount. So you'll say depreciable amount divided by, they will give you the useful life, to say the useful life is 4 years, for an example. So you'll divide by 4 years, and then you'll multiply by the months in use, right? Divide by 12. So if you have used the asset for 7 months, you'll say 7 over 12. If you have used the asset for 12 months, it's going to be 12 over 12, right? So this is the first approach, right? If they say the straight line method or the cost, you take the cost. Remember, the cost is the price at which you bought the asset, right? It's going to be the invoice amount, the price at which you bought the asset, times 100 over 115. So if the business is a registered VAT vendor, you have to exclude VAT to get this amount. I hope we are still on the same page. So if they say we are using the diminishing balance method, right, or the carrying value method, the approach then is going to be different. So the approach that you are going to use, you are going to say cost, right, which is the cost price excluding VAT if the business is a registered VAT vendor. Let's say you are buying the asset for the first time, and then minus accumulated depreciation, right, and then that's going to give you the carrying value, right? So it's either this will be on the, if you are buying a new asset, this will be on the additional information, or you are going, if maybe you are calculating depreciation of an old asset, and then this amount is going to come from the trial balance, and then this one is going to be given from a trial balance. But sometimes you have to calculate it on your own, which is rare, you see. So you'll say cost minus accumulated depreciation, you'll get the carrying value, and then you'll say carrying value, and then to get depreciation, you'll say carrying value, right, multiplied by the depreciation percentage that is going to be given times months in use over 12. So that is the difference between the two methods, right? With the straight line method, you calculate depreciation based on the depreciable amount. With the carrying value method, you calculate depreciation based on the carrying value, right? This is the difference between the two methods. Then the next thing that you need to consider, you have to look at the dates, right? It's very important to understand the dates and their meaning. So dates tell you for how long have you used the asset. They help you to answer the question, for how long have you used the asset. So that's what dates tell you, right? You'd agree with me that if you buy a new asset during the year, right? If you buy a new asset during the year, that means that, let's say you have a financial year from January to December. If you buy a new asset maybe in June, or let's say in July, right, 1 July, so it means that you are going to use that asset for July, August, September, October, November, December, which is 6 months. So here, when you work out the months in use, right, you'll say 6 over 12. So you'll say depreciable amount over useful life, which will be given, let's say it's 4 years, and then you multiply by 6 over 12. Why? Because you've only used this asset for 6 months, right? Remember, dates tell you for how long have you used the asset. Then another thing that you need to consider is that, let's say now there's an asset that has been disposed, right? So before you dispose an asset, before you get the rid of an asset, maybe by selling it or by scrapping it, that asset, before you get rid of it, before you dispose that particular asset, you would have used the asset. I hope we agree on that. So let's say now you have the financial year January to December as well, and then you decide maybe on 1 May you decide to sell the asset, right? So that means that when you work out the depreciation on the disposed asset, you are going to calculate from January, right? You want the months that you have used the asset. So this year, before you sold the asset, right, on 1 May, you used the asset from January, February, March, April, right? You used it for 4 months. So that means that when you calculate the depreciation on the disposed asset, right, you are going to use 4 over 12. So you'll take the depreciable amount, divide by the useful life, and then multiply by 4 over 12. And then also, if maybe by any chance you have an asset, not even by any chance, right, you also have to calculate the depreciation on remaining assets, right? So if you are working with vehicles, for an example, you'll separate the calculation for depreciation for the new, for the disposed, and for the remaining asset, right? So when you work out the depreciation for the remaining assets, you need to be very careful here. You need to be very, very careful when you want to work out the depreciation for the remaining assets. Now, you need to be very, very careful. So let me just quickly explain this thing this way. Let's add a page. Let me explain this thing this way, right? So if you have a remaining asset, right, you need to also calculate the depreciation there. So for the remaining assets, you need to know as to the balance that is given. Let's say you are given a balance statement of, you are given a trial balance, right? You are given a trial balance. So this is where I need you to listen, guys, because this is where people make mistakes. So when you are given a trial balance, it's either they will give you the balances at the end, or let's say at the beginning. So the balances that are given, it can be balances at the beginning, or it can be balances at the end, right? It's very important for you to look at this. Check the trial balance that you are given. The amounts that are given, is it the amounts at the beginning of the year or the amounts at the end of the year? Why? Because this will tell you then, or this will guide you in terms of whether or not to subtract the amounts that come from additional information or not. I'm going to explain that just now. So if you are given the amounts at the beginning, right, let's say you are given the cost of an asset, let's say to be 700,000 for an example, and then you are given the accumulated depreciation to be, let's say, 250,000, the accumulated depreciation. So if you are given the amounts at the beginning, right, you'd agree with me that this is before any adjustments, right? This was before any adjustments, right? So if maybe the adjustments, they say we bought, right, adjustment 1, we bought maybe a new vehicle. Let's say this amount, we are working with vehicles, a new vehicle, right, maybe for 100,000. And then another adjustment says you sold a vehicle with an original cost of maybe 80,000, right? So let's say this is what you have, and then the amounts that are given, it's amounts at the beginning, right, of the year. So that simply means that this 700,000, if you think about it, it represents the what? It represents the cost of the assets before any of the following adjustments were taken into account, right? So this 700,000 does not include the 100,000, right? Because the 100,000, because this new vehicle was bought during the year. So this 700,000 does not include the 100,000, right? However, this 700,000 still includes the 80,000 if you think about it, because the vehicle was sold during the year, and then the balance here that is given is the balance at the beginning of the year, right? So it means that this 80,000 has not been subtracted from these balances here. So when you calculate the depreciation on the remaining, you need to check if maybe you have the amount at the beginning of the year, the balances that are given. Is it amounts that are at the beginning of the year or the amounts that are at the end of the year? So if it's amounts that are at the beginning, then you should know that they have not accounted for the adjustments that are given in the question. So that means that if they say we bought a new vehicle, it means that that vehicle was not added on the 100K, right? If then they say you sold a vehicle with an original cost, right, of 80,000, that means that this 80,000 is still included here. So when you calculate the depreciation, remember I just said that you are going to separate the depreciation of the new asset, of the old asset, and the remaining assets. So when you calculate the depreciation for the new, you are going to use the 100,000, right? So you'll say cost is 100,000. You are going to use the cost of 100,000. And then when you calculate the depreciation of the disposed, you are going to use the 80,000 there, right? And if there's a residual value and whatever, follow this process here or this one, depending on the question. And then when you want to work out the cost then of the remaining, right, and the balances that are given, it's balances at the beginning, what you are going to do then, you are going to say, okay, since the 80,000, since the 80,000 is included in the 700,000, so I'm going to say 700,000 minus 80,000 here, right? Why are you minusing this 80,000? Because if you don't minus it, it means that you'll be doing double accounting. Why? Because already here you have calculated the depreciation for the vehicle that you are selling or that you are disposing. So if you don't subtract it here, it means that you'll be doing double accounting, right? So you need to subtract then. If the balance that is given is the balance at the beginning, you need to subtract the depreciation, you need to subtract the cost, you need to subtract the cost of the asset that is being disposed or that is being sold, right? That's the first one. If then you are given the amounts at the end, the adjustments are the ones that are going to guide you. So let's say same scenario, but these amounts is amounts at the end. So if you are given the amounts at the end, the transaction is going to guide you the adjustment. So if they say the adjustment was not recorded, right, it simply means that it's the same scenario as this one. So if they say maybe you bought a new vehicle and then you also bought you also sold a vehicle during the year with a cost price of 80,000, that means that these amounts are not recorded, right? It means that the balance that you have there, even though it's the balance at the end of the year, it does not include these adjustments, right? It means that it does not include, or it's before adjustments, right? If they, it's before the adjustment, right? It's before the adjustment. If they say the transaction was not recorded and you are given the balances at the end. So that's number one. But number two, they can say that the transactions were recorded. So if they say the transactions were recorded, in this case, that means that the 700,000, which is the cost that is given at the end of the year, right? The 700,000 includes the 100,000, right? So when they bought the new vehicle for 100,000, it was added, right, to make this 700,000. And then also, if they say the transaction was recorded when you were selling the vehicle, right? So that simply means that the 80,000 has already been subtracted to get to this 700,000. So that is the difference. So when you work out the cost of the remaining vehicle, you always need to check whether or not the transaction was recorded or not. You also need to check if the balances that are given on the trial balance, its balances at the beginning or at the end. If its balances at the beginning of the year, it's very simple, right? It means that whatever adjustments that you have, they have not been taken into account in the balance that you are given, right? So that means that if you then sell an asset during the year, you still need to subtract its cost from the other vehicles that are there. So, and then if you are given the balances at the end, right, you need to check from the question if the transaction was recorded or not. If the transaction was recorded and you are buying, it means that the cost of the new vehicles is included in the cost in the trial balance. And then if you are selling, it means that the cost of the vehicle that you are selling has already been subtracted in the amount that is given at the end of the year, right? So that's how you work this thing out, guys. I hope this part makes sense, right? If you are given the transactions at the end, you need to check whether the amount has been recorded or not. If it's not recorded, you do it like this one, right? It means that the balance that is given on the trial balance is before the adjustments, right? But if they say the transactions have been recorded, it means that the 100,000 has already been included, right, in the amount that is given in the trial balance. And also it means that the 80,000 has already been subtracted in the amount that is given on the trial balance there, you see. So, and then when you work out the depreciation, when you calculate the depreciation of the vehicles, you are going to separate the depreciation of the new vehicles, the depreciation of the vehicles that are disposed, and the depreciation of the remaining vehicles, right? And then you calculate them based on whether or not you are using the cost or the diminishing occurring value method. Okay, and then from there, what else? Okay, since we have discussed asset disposal, I think we need to talk about the journals quickly, right? So if we were to discuss the asset disposal, remember asset disposal, right? To dispose means to get rid of something, is to remove something, right? So to dispose is to get rid of something. So here you are getting rid of an asset. There are different ways to dispose an asset. You can sell it, or sometimes you need to write the asset off, right? Sometimes some companies, they donate assets. All those things are asset disposal, right? So when you dispose an asset, right, the first thing that you are going to do, you are going to remove the cost, right, of the asset that you are selling. So you are going to say, okay, I'm going to credit, let's say vehicles here. Let's say we are working with vehicles. I'm going to credit vehicles. And then why am I crediting the cost of vehicles? Right here, use the cost price. Why am I crediting the cost of vehicles? Because of I am maybe selling these vehicles because of asset disposal. So you credit vehicles and debit what? And debit asset disposal. Then remember, when you use an asset, it accumulates depreciation. So when you cancel out, when you remove the cost of the asset, it means that you also need to remove its accumulated depreciation, right? But before you remove the accumulated depreciation, most of the time the asset will be maybe sold during the year. It means you must calculate the depreciation for the year for that particular asset, right? So the amount that you get when you calculate the depreciation of the asset that you are disposing is the one that you are going to record here. So you are going to say debit depreciation, this is SPL, and then credit accumulated depreciation, right? Then you record your amounts here. So this is SFP. And then you cancel out the accumulated depreciation of this asset that you are selling. So when you cancel out the accumulated depreciation, you debit accumulated depreciation, right? Because remember, the accumulated depreciation account, it increases on the negative, on the credit side, right? So when you want to cancel out the amounts that are here, you'll cancel the amount on the debit side. So that is why here we debit accumulated depreciation, SFP, right? And then you are going to credit what? You are going to credit asset disposal. So you are simply saying, I am removing the accumulated depreciation of the asset that I'm selling. Why? Because it's no longer in use, right? So you credit asset disposal here, and then with the amount, right? Which amount do you use here? You use the amount of the balance for accumulated depreciation. So it's accumulated depreciation at the beginning, right, plus the depreciation that you just calculated, right? So you'll add this depreciation. The accumulated depreciation at the beginning, most of the time, is given accumulated depreciation at the beginning of the asset that is being sold, plus the depreciation that you just calculated here will give you the answer. And then from there, you check if you sold the asset for cash, right? You are going to get a particular amount. So if they say maybe this asset with a cost price of 80,000 and accumulated depreciation of 40,000, right? Accumulated depreciation of 40,000 at the beginning of the year was sold for 115,000, right? This amount is including VAT. That means that when you record now the proceeds from the sale, when you record the income from the sale, you'll debit bank, which is SFP, right? And then since you are selling an item, you'll credit VAT output, right? So the VAT output is SFP. You'll say 115,000 multiplied by 100 over 115. So not 100, sorry, 15 over 115. So that is going to give you, I think it's 15% or 15,000. And then the amount then that you are going to credit, right? You debit bank, you credit VAT output, and then the amount that you are going to credit is what? The account is asset disposal. So you are simply saying here, I am debiting bank, I am increasing my bank by 115,000 because I have sold an asset, right? SFP, because I've sold an asset. So you'll say asset disposal, the amount excluding VAT here is 100,000. So 100 plus 15 is going to give us 115. And then the last journal that you calculate, the last journal that you create is the journal for a profit or a loss, right? You need to calculate the profit or loss on what? On sale, right? Profit or loss is the selling price excluding VAT, right? Means that it's going to be this 100,000 minus the carrying value of an asset. How do you get the carrying value of an asset? It's cost minus accumulated depreciation, right? Which accumulated depreciation? This accumulated depreciation that you calculated here. So you take the cost minus accumulated depreciation, and then you are going to get the carrying value. So with the carrying value, you'll say selling price minus carrying value, right? And then you get a positive or a negative answer, right? If you get a positive answer, it means that you made a profit. If you get a negative answer, it means that you made a loss, right? So how do you record this? When you made a profit, you will say, okay, debit asset disposal, right? You debit asset disposal. When you made a profit, you debit asset disposal, and then you credit profit on sale. Why is profit on sale credited? Profit on sale is an income account, and income increases equity on the credit side. So SPL. So you'll credit profit on sale and then debit asset disposal. And then if we had made a loss, right, this amount was going to be negative. A loss is an expense, and expenses decrease equity on the debit side. So that means that you debit a loss on sale and then credit asset disposal. Does it make sense? So it's going to be like that, you see. And then you're done with your ledger accounts. This is how you think through this information from a question. And then how do you do the how do you do this, the note, right? So guys, the note is straightforward, right? The note, the amount at the beginning, cost is going to be given, and this one is going to be given. Accumulated depreciation is going to be given as well, right? Is going to be given. So you minus that, and then you are going to get the carrying values. From there, you put on your addition. So if you bought any new, let's say vehicles, you are going to put them here. If you bought any new machinery, for an example, you are going to put it here. And then for the disposals, right? For the disposals, it's disposals at carrying value, right? So if you sold an asset during the year, you are going to take the cost of an asset, you are going to take the cost of that asset and minus the accumulated depreciation of the asset that you are selling. And then that will give you the disposals at carrying value, right? You take the cost and minus the accumulated depreciation of the asset that you are selling. That's going to give you the carrying value of the asset. Then the depreciation for the year is what? The depreciation for the year is the depreciation of the new plus, right? The sold assets, or the assets that you disposed, plus the depreciation of the remaining or the old assets. So you add them together for vehicles and record the amount. You'll add them together for furniture, and then you'll put the amount here. This amount must be negative, right? And then this part, right, to get the gross carrying amount at the end, which is cost, right, you'll take the balance at the beginning. Okay, let me do it like this. To get the cost, which is this amount, right, at the end, you take the balance at the beginning, then you add the new class, right? You'll add the new asset at cost, right? And then you'll minus the sold, or let's say the disposed asset, right? So you'll minus the cost of the disposed asset. You'll minus the cost of the disposed asset. And then this calculation will give you this amount here. And then for accumulated depreciation, which is this one, you'll say, okay, to get the accumulated depreciation at the end, right? It's very simple as well. You take the accumulated depreciation at the beginning plus the depreciation for the year, right, which is this amount, plus the depreciation for the year, which is this amount that you calculated, and then you'll minus the accumulated depreciation of the asset that you are selling, right, or the asset that is being disposed, right, which is this accumulated depreciation that you would have recorded here, this amount, you see. And then when you take that, add depreciation, and then minus the accumulated depreciation of the asset that you are selling, that is going to give you the carrying value at the end. So now you'll have this amount and this amount, and then you subtract them, it's going to give you this one, and then you are done with your PPE note, right? So this is how you need to think through PPE, guys. It's not a very easy standard, but it's very, once you understand what you are doing there, you'll see that it's very, very simple, right? You need to understand the difference between depreciation and accumulated depreciation, the different depreciation methods, and then you need to know how to use the dates to calculate, or as part of your calculation, the dates tell you for how long have you used the asset. The new asset, you calculate the depreciation from the date of purchase till the end of the financial year. For the asset that you are disposing, you calculate depreciation from the beginning of the financial year till the date of sale. And then for the remaining assets, it's going to be 12 months, right? So you use 12 over 12 there. Yeah, that's that. You also need to know how to do the leisure accounts. You also know how you also need to know how to record on the property, plant and equipment note. And as you can see, it's very, very straightforward. You see, yeah, it's very, very straightforward. So yeah, just try, like when you approach the questions or when you do the questions, like try to keep these things in mind, and then you'll see things are going to be easier. Things are going to be easier for you. But again, yes, anything other than these guys, I think you'll be fine, man. So yeah, I'm just going to close this video because I don't want it to be too long. Remember, I'm just discussing the principles. It's your responsibility to go and practice on your own. Otherwise, all the best for your test. Make sure that you start with easy questions to build confidence and collect most marks at the beginning, so that you have time to do the challenging questions as well. And yeah, please like this video, comment if you want to comment, and then share this video with your friends, with your colleagues, and everyone who's taking the module, so that they can benefit from this information. Thank you very much.